Welcome back to Talk Tickers. This is the place where we break down the quarterly calls so you don't have to. Today, we are digging into Bloomin Brands, that's ticker BLMN, and their fiscal third quarter 2025 earnings call. Our mission is pretty straightforward. We're going to pull out the key financial nuggets, lay out the big $75 million turnaround plan, and figure out what's really next for Outback Steakhouse.
And that Outback story is, it's really the whole story right now. You could just feel it on the call. Management finally has the proof they needed that their strategy is starting to work.
Validation.
Exactly. After a tough stretch, this quarter showed real momentum, and that's giving them the green light to go all in on this big structured turnaround.
Okay, so let's get into that momentum with the numbers. The headlines were all about a pretty decisive beat.
Oh, absolutely. Total revenues came in at $929 million.
Up from $910 last year.
Right. But the real surprise was on the bottom line. They posted an adjusted diluted loss of -3 cents per share. Now that sounds bad, but their own guidance was for a loss between 10 and 15 cents.
So they completely smashed expectations on profit.
They crushed them. And that really came from strong execution on the top line. U.S. comparable restaurant sales were up 120 basis points.
Which is a huge acceleration from Q2.
A massive one. It's a 130 basis point improvement over the second quarter. I mean, it's a complete trend reversal.
And for any restaurant, especially one that's been struggling, it all comes down to one thing.
Yeah.
Traffic. How many people are actually walking in the door?
And that's the real silver lining here. U.S. traffic was down just 10 basis points.
Barely anything.
Barely anything. And it's a massive 190 basis point improvement from Q2. They are getting people back. And for the first time since the first quarter of 2023, every single one of their brands had positive comp sales growth.
That is a definitive signal. It tells you their big shift towards value is working with consumers who are, being pretty careful with their money.
It is. And they immediately baked that confidence into their guidance.
Right. They lifted it.
They did. They raised full-year U.S. comp sales to a range of flat to plus 50 basis points, and they tightened up the EPS guidance to $1.10 to $1.15. They're clearly signaling they think this momentum is going to last through the holidays.
Okay. So sales up, traffic stabilizing, better outlook. Let's pivot to the margins because that's where the future of this company will be decided. Sales improved, but adjusted operating margins actually got squeezed, right? Down 150 basis points from 2.3% to just 0.8%. What was eating into that profit?
Well, it was a 1-2 punch of high inflation and a strategic choice not to pass all of it on to the customer.
Let's start with the inflation.
So cost of goods sold COGS inflation was up 4.9% and labor was sticky at 3.3%.
Whoa, that 4.9% on COGS, that really jumps out. Is that all food costs or is there something else going on there?
That's a great question. And yeah, you have to understand the accounting here. That number is a bit noisy because they are lapping a huge rebate they got in the third quarter of last year.
Ah, okay. A one-time thing.
Exactly. So think of it like this. Last year's costs were artificially low because of a big supplier discount. So when you compare this year's costs to that low baseline, it makes the inflation look much worse than it actually is. It's an optical effect.
That's critical context. Still, the margin compression shows they're deliberately choosing to drive traffic with value, even if it hurts profit in the short term. I mean, look at the average check. Menu price is up 3.7%, but the average check only went up 1.3%.
And that gap, that 2.4% difference, that's the strategy in a nutshell. It points to a clear negative mix shift.
Meaning people are coming in, but they're managing their own bill.
Precisely. They're trading down, maybe skipping that second glass of wine or an expensive appetizer. They're finding value within the menu itself.
So the company's meeting them where they are economically.
That's the idea. And what's impressive is that even with all this focus on in-store value, their off-premises sales held steady at 24% of total sales. So their takeout and delivery business is proving to be very durable.
All right, so let's drill down into how that value equation played out at the actual brands. We have to start with Outback.
Outback, yeah. First positive comp sales quarter since Q2 of 2023. They came in up 40 basis points with traffic essentially flat.
And that was all because of the OC three-course meal, right?
100%. That's their 3-course value meal that starts at $14.99. But what's really fascinating is the psychology. That low entry price gets people in the door, but management said 2/3 of those guests actually trade up to the $17.99 or $20.99 versions.
The hook works?
The hook works, and then the quality of the offer encourages the upsell. It's smart.
How did the other brands do with similar plays?
Bravus was the star performer. Comp sales up 410 basis points, traffic up 60 basis points. That was all led by their $45 dinner and dolce for two deal.
And Bonefish?
Bonefish also had its first positive comp quarter in a long time, up 80 basis points. That was mainly driven by day-of-the-week promotions, especially their $5 Martini Margarita Mondays.
So the strategy is working across the board.
Yeah.
And management's take on the macro picture is that dining out is still seen as an affordable luxury.
Yeah, and the numbers really back that up. They said the traffic improvements were consistent across all their brands, across all income groups, and importantly, across all ages.
But they did see one small area of weakness.
Just one, yeah. In the 65-plus group, they saw a little bit of a pullback, but it was almost entirely on beer, wine, and liquor sales.
So even the cohort that's often on a more fixed income, they still chose to go out to eat. They just managed their check once they were there.
Exactly. They controlled their spending inside the restaurant instead of just staying home.
That right there, that's the validation management needed to pull the trigger on the big formal Outback turnaround strategy. Let's get into the architecture of that $75 million plan.
Right. This was the centerpiece of the whole call. So it's a planned $75 million investment spread out from 2026 to 2028. But, and this is a big but, it's not a $75 million net cost.
Because they're offsetting it.
They're offsetting it with about $80 million in productivity savings over the same period. These are non-guest facing things, supply chain, back office stuff.
So the actual net investment is pretty small.
It's only about $20 million in 2026 when most of the spending happens. And the sequencing here is so important. They're not going to spend big money on marketing until the core product and service are excellent everywhere.
Build the foundation first.
Don't paint the house before you fix the foundation.
Exactly. Okay, so platform one is all about that foundation. Quality and service. This is where the money is going first.
A lot of money. They're putting $25 million in 2026 alone just into the center of the plate food quality.
It's steaks.
It's all about steak excellence. And they tested this. The tests showed a 10-point lift across key guest metrics, satisfaction, value, quality, after they made the steak better. So that national rollout is starting immediately.
And then there's the service part, which to me sounds like the hardest piece of this.
Yeah.
They're changing the server-to-table ratio.
They are. During peak hours, they're going from 6 tables per server down to 4 tables per server. That starts in Q2 of 2026.
Okay, wait. 6-to-1 down to 4-to-1. That's a 50% increase in servers needed during your busiest time. I mean, that sounds like a massive hit to labor productivity.
It does, and it's a huge red flag. But management is betting that the current service level is their biggest problem. Their tests show that the 4-to-1 ratio dramatically increased scores for intent to return and attentiveness.
But can you really pay for 50% more staff with just, better morale and faster table turns? Yeah. That feels like a monumental gamble.
It is a gamble, no question. But it's a calculated one. They believe superior service will lead to higher checks and more frequent visits that will more than pay for the extra labor. It's a long-term investment in the experience.
Right. Platform 2 is about brand relevancy and marketing, and this is where they're trying to get younger.
Yeah, they're going back to their roots, that whole fun Australian, come as our guest, leave as our mate vibe, emphasizing their steakhouse first.
But the real change is in where they're spending the ad money.
It's a massive pivot. They're going from a legacy mix of 70% linear TV and 30% digital, and they're flipping it. It's going to be closer to 40% TV, 60% digital.
So they're finally abandoning that old model that was probably just hitting older demographics and wasting money. This is about targeting younger people where they actually are.
Exactly. And again, notice the discipline. The extra $10 million in marketing for 2026, it's all loaded into the second half of the year.
After the new service model and better stakes are in place.
You got it. Don't advertise a promise you can't keep.
Okay, finally, platform 4, asset refresh and portfolio discipline. This sounds like a big shift in capital spending.
It is. They're basically saying no more new restaurants for a while. All that capital is being shifted away from new openings and into refreshing and remodeling their existing locations. The goal is to get nearly 100% of Outbacks refreshed by the end of 2028.
And they're using that $400,000 model for it.
Yes, the 400K refresh, it's all focused on guest-facing areas, the dining room, the bar, the lighting. And they're using that number because it's based on what worked at Carrabba's. That kind of light touch refresh yielded a clear 100 to 200 basis points of traffic lift right after it was done.
So the bet is that they can replicate that success across almost 1,000 Outback locations.
That is the entire bet. And it makes sense. It's about the feeling, the ambiance. Does the place feel relevant and cared for? That's what drives repeat visits.
And speaking of discipline, they're also doing some house cleaning.
Closed 21 underperforming restaurants just last week across the brands, and they've identified another 22 whose leases they won't renew over the next 4 years. It's a very clear signal they're focusing resources on their winners.
Which brings us to the investor context. I mean, the biggest signal on the whole call had to be suspending the dividend.
That was a huge move, and they were so transparent about it. They basically said, we're taking this capital and putting it back into the restaurants, our employees, and paying down debt.
It's management saying a better steak and a nicer dining room is a better return on your money than a small dividend check.
A much better return. They're prioritizing deleveraging and CapEx over shareholder payouts. It's a fundamental shift.
So what are their debt targets now?
Well, the big Brazil refranchising deal helps a lot. Once they get that $122 million payment, they expect lease-adjusted net leverage to drop from 4.3 times down to 4.0. The long-term goal is to get that down to 3 times by the end of 2028.
So the plan looks like it's funded. But they did flag a couple of risks for their 2026 guidance.
2 big unknowns, yeah. First is where beef inflation is going to land next year, which is very volatile. And the second is getting a clear view on any potential tariff impacts.
And beef is their biggest single cost. So any spike there could really mess with their ability to keep offering those value deals that are driving traffic.
It absolutely could. That's the key risk to watch.
All right, that brings us to our final segment where we take all this analysis and get a little creative. This is not financial advice. This is for entertainment only. We're pitching an outrageous but maybe plausible trade idea based only on what we heard on the call.
Okay, so the core idea here is that the market is completely underestimating the cumulative effect of all these changes hitting the system at once, starting in mid-2026.
Lay out the pitch.
The pitch is to initiate a long position, but you're not focused on the 2025 multiple, which is pricing and, continued stagnation. You're looking out to the implied EBITDA in 2027 and 2028.
And the outrageous part.
The outrageous part is that you are betting everything on the success of that $400,000 remodel strategy. You're assuming the 100 to 200 basis point traffic lift they saw at Carrabba's can be replicated across the entire Outback system.
So if the remodel gives you, say, 150 basis points of traffic, and the better service and better steaks add another 150, you're modeling a permanent traffic lift of 300 basis points or more by 2027.
Exactly. The market sees $75 million of investment. We see a 300-plus basis point permanent traffic annuity that completely reprices the stock based on a future free cash flow that nobody is modeling today.
It's a bet that all these tested initiatives actually scale.
It is a bet on execution and that the savings they've identified really do materialize to fund the whole thing, leading to this massive, underestimated cash flow inflection point in a couple of years.
Okay, we have covered a ton of ground today. To sum it up, Bloomin Brands showed strong Q3 momentum, which validated their value strategy. Now they've launched a very structured, disciplined turnaround for Outback, funded by suspending the dividend, all focused on getting the steak quality and the service right first.
And my final thought for you to chew on really connects this all back to the consumer. If people, even the more affluent 65-plus crowd, are cutting back on things like alcohol, but are still prioritizing the act of going out to eat, how deep is that willingness to pay for the experience?
That's a great question.
Does Bloomin's renewed focus on experiential dining, the wine dinners, better service, the 400K ambiance refresh, does that actually insulate them from more economic pressure? Or will people eventually just look for the cheapest option, no matter how nice the restaurant is?
That is the ultimate question of brand resilience. Thank you for joining us for this deep dive into Bloomin Brands. As always, this is for informational purposes only. Please consult your own professional advisor before making any investment decisions.
Until next time, stay well informed and keep your models tight.